All right, guys, welcome back. In this video, we're going to talk about how you can create a diversified portfolio in a very easy way, okay? The financial industry is all about finding opportunities and gaps in the market and then filling that gap with products. So they realize, hey, you know what? People want managed funds. They want managed mutual funds. We've got that. But people if you zoom out a little bit, they might have an equity mutual fund, but then they have a bond mutual fund. And how do they find the right allocation between stocks and bonds and international and domestic stocks and cash, small cap, mid cap, large cap? Doing that and rebalancing that over time is daunting. So what they did is they actually created a number of funds that will do all of that for you. Now, if you have an investment advisor, that's the investment advisor's job. Okay, that's what you're paying them to manage that process and make those selections. So this is like an investment advisor light way to go, where it's going to probably cost you less and you can just have one thing that just does it all for you. These are called asset allocation funds. So I just want to show you how these work. Now, if you go to mutual funds again, we're just going to look at Fidelity's. And you go to the asset allocation, what they do is this. They have target risk is saying, I want this % in stock. Okay, so Fidelity Asset Manager 70%, for example, is a 70% stock portfolio. Okay, so if you look at composition here, it's got 71 right now. It's like 72-ish%, and it's in large blend. And then here's domestic equities, here's international, this much in bonds, this much in cash. That's the allocation right now. Okay, so play 74%-ish in stocks and 25-ish% in bonds and cash. Okay, once it gets past a certain threshold, then they rebalance. So you buy this, you can see regional diversification, credit quality on the bonds like I talked to you about. So if it's US government bond or AAA or AA or BBB or whatever, what they do is they actually maintain this asset mix for you. They rebalance for you. So once it gets beyond a certain threshold, then they will correct it. They'll rebalance it. And they do that on an ongoing basis. So you don't have to. You just buy this fund based on how much you want in stock, right? It's 85% stock, 70, 60, 50, 40, 30, 20. And then they will manage it and maintain the asset allocation for you. Pretty nice. So let's just look, for example, at this S&P 500 compared to this fund. Okay, now this is 70 to 85% equity fund. S&P 500 has blown it out of the water because it's all stock, obviously. And this one is only 70% stock. So you see there over that time period, it can lag, right? And even though this fund dropped lower, we're gonna get rid of these two. This fund had a lower drop here when the pandemic hit. Remember, March 2020 is when it hit and the market just went crazy. And then the government said, hey, we'll spend trillions for businesses and send money to people. So then the market recovered pretty quick. But this had a lower drop. The S&P 500 dropped quite a bit more, but it also had a steeper recovery. So steeper drop, steeper recovery. This one dropped less, recovered less. And there we go. Over time, that is what you're going to get. Okay. Now for this fund, it's 0.67 expense ratio. That's the expense ratio you're paying. And over time, over 10 years, it's at 9% average annual return. See if we can see it compared to, So the life of the fund is 1991, 8.39 average annual return. Compare that to the S&P 500, which is a 10.6% average annual return over the life. And then this one, which is a Fidelity composite index of a 70% equity, right? It's right in line with that. So a little bit less, right? You're earning less over time, but you're not nearly as volatile. These peaks and valleys are not as pronounced like this one. Big decline here, more shallow decline here. Okay, so that's what an asset allocation fund does. Pretty nice. You pay one fee, it rebalances everything for you. Now, the next type of fund is actually a target date fund. This is something you've probably seen within your 401k, for example, right? They almost always have this option. Target date fund is, hey, I am going to be retiring, let's say around the year 2055. So I'm going to invest in the Fidelity Freedom 2055 fund. Okay, here we go. What this does, a Freedom target date fund, is essentially saying, this is the year I'm going to retire. And therefore, they know my time horizon, and I'm going to invest much more aggressively over the short term. And as I get nearer to retirement, I actually want to take less risk. And certainly in retirement, I'm going to take less risk. So they're going to automatically adjust my portfolio down from maybe aggressive growth over time to growth to then, moderate to then conservative. Okay, and they will do that for me. Okay, so let's look at this one. If we look at the fees, it's 0.75%. They also have index version of these. But what these do is they invest in funds. The asset allocation fund does the same thing. Instead of investing in a basket of stocks and bonds, it invests in a basket of other funds. Okay, so it's like a fund of funds. So right now, the allocation in this one is 85%. So US equities is 50%, non-US equities 42%, bonds 7%, short-term and other basically zero. So very heavy weighting towards stock, and really, really heavy towards international stock too. Okay, 50% US, 43% non-US, and then 7% bonds. But over time, as you get closer to that date, right, of 2055, your estimated retirement date, then they are going to shift the allocation and drop equities in favor of bonds. So they're going to make that shift for you. Okay, so pretty nice. It's all taken care of. You literally don't have to think about anything. Pretty great. Okay, so there's the mix right there. And you can see performance-wise compared against the S&P 500. Obviously, it's not all stock, though it is largely, but we can see how it's compared against the S&P 500. Okay, S&P 500 has outperformed it a lot. Why is that? A couple reasons, probably. We can just kind of deduce, right? There's bonds in here, so that's going to slow things down. And then there's 40% in international equities. And international equities have underperformed for about the last decade. Since the financial crisis, they just haven't bounced back as well as US domestic companies. So you get half of the US performance in here, half international. And so it's going to lag between the all US. That's not always the case, but it has been the case for the last decade or so. So there you go. Now you might not like that. You might say, hey, I actually will do that myself, but I'll do 85% S&P 500 and 10% international or no international or whatever. So the downsides to these are you might not totally agree or like how they've decided to split this up. And you might, I don't want that many non-US equities. Cool, that's fine. You just have to build your own. But as far as ease and simplicity, there's some fees and all that stuff. But as far as ease and simplicity, it's pretty hard to beat, really. It's been around since 2011, obviously, because it's 2055 fund. So people were not in the workforce before 2011. So this fund they roll out. There'll be a 2060 and 2065 and 2070 as time goes on, right? But over its life, which is over 10 years, 10.2%. S&P 500 is 15% over the life or over that time frame. So not bad. More diversified. You're not getting quite the gains, but you're probably not getting quite the losses either. But they're overall probably pretty comparable. Okay, so that wraps up asset allocation funds and target date funds. Makes it really easy. If you just want a one-stop shop, easy to do it that way. All right, we'll see you guys in the next video.
Hope that gave you some clarity. See you in the next one.